Hey, Bulls and Bears, it's Sunday night, back with another dose of economic reality. A lot of people are probably going to be watching this on Monday. So, as I'm recording this, it's Sunday night, November 13th, and tomorrow's going to be November 14th. So, for those of you watching this, if you think I got the date wrong, well, you're probably watching this the day after I put it out. It is a late night video. Today was a very busy day in my household. A lot going on for those that have more than one child. You probably know what I'm talking about. Things can get very hectic, and you can be pulled in a lot of different directions as a parent all at one time. I'll touch on this briefly, then we'll get into the news. Parenting in general is way more difficult than I ever thought it was going to be. I always heard people talk about being a parent is the hardest job in the world. Yeah, and then some. It can really be a time taker, put it that way. But hey, I'm back and I make my schedule here. I put out videos when I can, and thank you for coming back to join me. Let's get into the housing market here. Housing market news. The housing crash that never was. The 2022 housing market. I go back and I look at some of these channels out there that say the housing market is crashing or it's going to crash, and then it's going to happen next month, next month. I've always said here, the second half of 2022, we're going to start seeing some price declines, but it's going to be a slow motion decline, and I've been proven right. Take a look at this article here. This is out of NAR.com. That's National Association of Realtors. An overwhelming majority of metro markets saw home price gains in the third quarter 2022. That's July, August, September of this year. Double-digit increases, even with 7% mortgage rates. 46% of the 185 tracked metropolitan areas registered double-digit price increases year over year. So year over year, third quarter, 46% of these metro areas are up double digits. That's 10% or more. So no home price crash. Now, some cities, yes, prices are coming down. I wouldn't define it as a crash since it is just a few cities right now that are down year over year when you look at the median home price. And we'll talk about those cities here in just a minute here. The national median sales price climbed 8.6% overall from a year ago to $398,500. That is a 14% increase compared to, or decrease rather, from the previous quarter. So in the second quarter, prices were up 14% year over year. In the third quarter, this is nationally, home prices were up only 8% year over year. So there is a deceleration, but home prices are still up. And this is overall. In almost half of the cities, the major metropolitan areas, by double-digit increases, right? 10% or more. So definitely not a housing market crash. But let's talk about some of the cities. There are some exceptions here. Here's some of the markets where prices are down year over year. And I'll let you tell me if you think this is a crash. I don't think it's a crash. I think it's so far a mild correction. It is going to get worse. I'm not saying that home prices are going to go back up. It's definitely going to get worse, and prices are going to come down more as long as they don't tamper with the mortgage rate. But it's definitely not the crash that so many people were predicting. All right, now let's talk about the hardest hit cities where prices are down year over year. And even the cities that saw the biggest price drops, they're not down that much. Number one, Boise, Idaho. Prices are down 3.9% year over year. Is that a crash? You let me know. Phoenix prices are down 2.3%. Las Vegas prices down 1.9%. Austin down about 1%. Are those crashes? I don't think so. But they are declines. And even with a small decline, if you bought a home at the peak and now you're underwater, if you didn't pay cash for that home or if you didn't have a big down payment and your home is now worth less than what your loan is, that's not a good feeling. So anytime a price drops year over year, it's big news. And this is going to be a big correction in the housing market. It's just not going to be the crash that so many people predicted, and that's what I wanted to put out there. But let's move on from the housing market into some other news. Let's talk about the Great Resignation. So there was a time, and it's still here somewhat, but there was a time where the Great Resignation is what it's been called, where employers could not hold on to workers. A lot of people wanted to work at home. A lot of people started social media, uh, methods of income and other methods of income working for themselves. But now take a look at how things have changed. This is out of Fortune here. The great remorse takes over the great resignation, as most workers who quit their job are having a hard time finding a new one. So things have changed. We have this wave of layoffs now, started in the tech sector and real estate, and now it's expanding to other sectors. And a lot of these people that were, out there and quit their jobs and went on to find a better job, or what they thought was a better job, found out the hard way that it was just temporary. A lot of people jumped into real estate in 2020 when prices started zooming. Loan officers, appraisers, realtors, of course. And, a lot of them are finding now that the slowdown is too much to bear. Quick excerpt here out of this article. A new Harris poll, first reported by Bloomberg, surveyed over 2,000 job seekers. Recent experiences with the labor market. Over 70% of them said it has been harder than they'd hoped to find a job that they were looking for. It's interesting that when there's a market boom going on, and we can look at real estate, we can look at just the economy in general, because when interest rates are low, mortgage rates low, and people are borrowing and spending, jobs are plentiful. And then when things change, when interest rates rise, and when the people carrying all this debt, especially credit card debt, they are starting to see some big trouble, and they have to pull back on their spending, and then the layoffs start to increase, just like we're seeing right now. Things change. Things change drastically. And when companies do hiring freezes and then lay off people, look at Amazon hiring freeze. I think it was Microsoft hiring freeze. A lot of tech companies laying off. We have Meta, which is Facebook, out there laying off a lot of people. Of course, Twitter, but that's a whole bigger mess than just the economy over at Twitter. We've got Lyft and other, new and upcoming companies that are what were thriving at one point, now laying off a lot of people. And think about this. People borrow money based on their income at that time. So think about this. You're taking out a 30-year mortgage, many people, based on what you're making right now, as if nothing's ever going to change. The 30-year mortgage, the balance of that mortgage is there. That's not going to go away. Yes, you'll pay it down and maybe hopefully pay it off before 30 years, but you're putting yourself on a 30-year payment plan based on a job that you have today or what you had at the time of getting the loan. What if things change? Now you've got this 30-year mortgage, you've got this balance to pay, and now the job market's changed, the economy's changed. So isn't it crazy that we even have something as long as a 30-year mortgage? The only reason that's necessary is because home prices for decades have been way too high for people to realistically afford. And we've joked here about, there's going to be a 40-year mortgage, a 50-year mortgage. And, where does it end? It just gets to a point where it's so ridiculous, where somebody buys their home in their 30s or their 40, their age, 30 or 40s, they may not pay it off before they see the grave. It's nuts, man. But that's what it is. So, things change, the economy changes, and people have to find new lines of work. Let's talk about what a billionaire said. Carl Icahn. He's out there. This is out of Markets Insider. Stocks will plunge. Inflation will persist, and the U.S. economy will feel more pain. What? You mean there's not an amazing recovery? Right? We heard about this recovery ever since the end of 2020, when things started getting back to sort of normal. I don't think they're normal, but sort of more normal. Carl Icahn, there's 14 best quotes from a new interview. I'll just give you a couple of them here. Carl Icahn, I'm still quite bearish on what is going to happen. A rally like this, he's talking about the stock market rally in October, which is the biggest rally, I think, of all time for October. This is, of course, very dramatic, to say the least, but you have them all the time in a bear market. I still think we're in a bear market. And I've said it before, I think October, the big surge that we saw in the stock market, was a dead cat bounce. When you look at it, though, we're only down about 8% from the all-time high. But if you look to the beginning of the year, each rally that we had was less and less, right? The first rally, we got about 4% from the all-time high. The second one, about 6%. And here we are with this late year rally, and we're down 8% from the all-time high. But if you look at the beginning of the year, all these dead cat bounces have been followed by lower lows. So we'll have to see a couple months here down the road if I'm going to be right, but I think it's going to be lower lows and a continued bear market. I think this is a bear market bounce. I've said that. Now, Carl Icahn is out there. I don't agree with everything that he says, but he's out there kind of agreeing, with what the conclusion that we've came up to here. All right, another Icahn quote from this interview. I don't think the inflation is over. If I look through the 70s, it took years and years. You can't wave a magic wand and get inflation over with. And again, people think the rate hikes are going to fix inflation. If rate hikes were what it took to fix inflation, why are they raising rates slowly? If you want to fix inflation and get it fixed quickly, just raise the funds rate to 10% and get it over with. Why don't they do that? Because they know that the economy is based on leverage and people borrowing money, and that they would cause an instant depression if they did that. Obviously, the rate hikes are not going to fix inflation. Icahn agrees. Another quote here, then we'll move on to another story. The Fed has to keep raising. If it doesn't, then it's going to be worse for the future. They have to cure this inflation. It's not something where you can just take a magic pill and get rid of it. Now, when you say cure inflation with the rate hikes, look at the housing market. The housing market, look at automobile prices starting to come down a little bit. If it weren't for the rate hikes, you would probably still see prices going up in automobiles, and you probably wouldn't see any housing markets with price corrections, not even Boise, Idaho, which is the biggest one as far as price drops, down almost 4% year over year. The headline, you think the housing market's bad? The commercial real estate market's even worse. Prices are dropping by double digits and they're not done yet. So commercial real estate is actually leading residential real estate in price declines. As interest rates rise, you also see commercial real estate correct with it. Now, there's also trouble brewing with small and medium-sized businesses, and we see vacant strip malls here in San Diego. I've showed on camera some of the vacant strip malls in my neck of the woods here in San Diego, and some of them are completely wiped out. And just like residential real estate, loans are taken out in many cases to buy commercial real estate. So higher interest rates, higher rates in general are dampening the ability for companies to come in and pay so much for commercial real estate. So far, prices have dropped 13% from their peak. And just in October alone, just last month, prices were down 7.3%. So the commercial real estate prices are more of a crash than residential. I still wouldn't call it a crash, but it is a big decline. The Green Street Commercial Property Price Index also reports apartments, offices, strip malls, and healthcare-related buildings. They have experienced double-digit dips. Facilities, housing, hospitality, and self-storage businesses fared slightly better, down only about 6%. Of course, self-storage, a lot of people that are getting evicted and moving out of their home that they can no longer afford have to get self-storage. So it's no surprise that has not crashed as much as others. All right, folks, so it should be a very interesting week we're going to see here this week. I hope to see you back here on this channel. Gold and silver, we've got gold now up to $17.63. Silver back up to $21.50. Was down in the $17.50 range for a while. And that was a good time to accumulate silver, in my opinion. Silver is going to be a part of the next non-fiat money system after all this fake money economy is revealed as the reason for such financial pain that we're going to see a lot of people go through. Hopefully not you and I. I think we're going to come out this just fine, but we're going to have to keep an eye on it so we can stay ahead of the curve, folks. Please come back for more updates. Bye for now, everybody. Love you. Peace.